Hello, greetings, and welcome to Dividend Blasters. This is our 65th video, and I am so glad to be back. Topic today: invest in the right stocks with the fastest growing dividends. That's really what it's all about. It's about making sure that your investments pay a dividend and pay a growing dividend. You never want to hold on to anything where the dividend is staying flat or decreasing. The idea is to make sure you're staying ahead of inflation, and having that dividend payment grow is a really important part of it. So I'm going to go ahead and talk to you about 25 stocks that I selected across 7 market sectors that I believe are the fastest growing dividend stocks that you should look at. All right. First, a quick disclaimer. I'm not your financial advisor. Purpose of this video is for information and education. It reflects my own personal opinions, my research, and my experience as an independent investor for more than 30 years. So please do your own research and consult a financial advisor prior to making any major financial investment decisions. So how did I get to this 25? Well, I did a couple things. I had a couple of criteria. First, I decided to look mostly at the largest companies by market cap. That is the easiest source of information, is to look at the biggest companies. Any company in the top 100, and that was really where most of my focus was, has a market cap of more than $132 billion. That's the first criteria. Second criteria, I was looking at the dividend growth rate, or the dividend CAGR. The CAGR is the compounded annual growth rate. I want to see a CAGR of greater than 10% for a 10-year time frame, or the last 10 years. That's what I'm looking for. And I want to see that this stock has been growing for at least 2 consecutive years. My preference is usually 3 or 5, but for this exercise, I relaxed it a little bit to 2. I will say this. After going through and doing the exercise, I was disappointed that some of the stocks that I'm intimately familiar with, that I think are great dividend investments, were not in the top 100. Okay, their market cap was a little below 132 billion. So I went through and I made a special selection of about 8 stocks. And then I also made another relaxation of the requirement. If I saw something was close to 10, maybe 9.5, and I thought it had great tailwinds, I added it to the list. So there's 8 special selections. I'm going to go through them. All right. So, Discovery, as I mentioned, 25 dividend growth stocks across 7 market sectors. 6 of the 25 were in the technology sector, 5 were in the financials, 4 were in consumer discretionary, 4 were in industrials, 3 in healthcare, 2 in consumer staples, and 1 in materials. What's missing? Real estate. I didn't select any for real estate. I'm by and large, you're not going to see significant dividend growth. You'll see steady growth, but not significant dividend growth in the real estate sector. And utilities is missing. I have some utility stocks. There is one in particular that I have, Next Era Energy. However, what I don't like about utilities is that they have a negative unlevered free cash flow. They have lots of debt. They still pay the dividend. It's like they can't go out of business, but that's just something that bothers me. So I didn't select them, but I do own some utilities. All right. So those are the 7 sectors. There's 25 stocks. Let's get to the list. But before we do, just some terminology that most of you are familiar with, but if you're new to investing, you may not be. I'm going to talk about PE ratio, or price to earnings ratio. In quick definition, it's a stock valuation metric. It compares the company's share price to its earnings per share. When you buy a stock, you want the most favorable PE ratio that you can get. What's favorable? You want earnings to be going up. Ideally, you don't want price to be overvalued. So you want a lower PE ratio when you're buying. I'm also providing here for context what the S&P 500 PE ratio is today. For the entire market, it's about 22.37. I'm going to be showing you PE ratios for a bunch of stocks, and I'm going to be comparing them to the market sector so you can see how they do. You're also going to see dividend yields. You can see that the dividend yield for the S&P 500 is 1.44. It's kind of modest. Remember, not everybody pays a dividend yield, so that's going to drive the average yield down for the entire market. Okay, so that's PE ratio. A couple more definitions before we start. This is really more of a profitability metric. Uh, Cash flow. First, unlevered free cash flow, and then levered free cash flow. I'm going to be talking more about levered free cash flow margin in the next few slides, but let's talk about what it is first. Let's talk about, before we can do that, what's unlevered free cash flow. Unlevered free cash flow, and these definitions come from Investopedia. It's a wonderful resource. It's the amount of available cash a firm has before accounting for its financial obligations or its debts. Okay, if they're paying loans, if they're paying debt, okay, unlevered free cash flow does not cover that. That's good to know. I am more interested in levered free cash flow. And what is that? It's the money left over after all a company's financial obligations are met. So it's unlevered free cash flow plus payment of debt or loan payments. That's levered free cash flow. Why am I interested in this? I want to know that any stock I buy, any dividend stock I buy, has plenty of levered free cash flow so they can support a growing dividend. How do I know that they have enough? I typically I do a deeper dive than I'm going to do here today. I look at the levered free cash flow for the last 5 years. I want to see that it's stable and growing. I don't want to see levered free cash flow going down because then I get a little concerned that maybe they're not going to have enough cash to support a growing dividend. So what's levered free cash flow margin? Well, it's levered free cash flow divided by revenue. Okay. I like to see a growing levered free cash flow margin compared to revenue. I want to know that there's more cash available after all expenses and all debts paid compared to revenue. I think that's a great benchmark. All right. Those are the definitions. Let's get to the stock picks. And I'm going to go through this sector by sector. We're going to start with technology, then we're going to go to financials, and then we're going to keep going. All right. So, technology. First and foremost, Broadcom. Look at that 10-year CAGR, 36%. That is the second highest CAGR on this entire list. They've been growing their dividend for 13 consecutive years. It's a modest dividend yield of 1.67%. But I'll tell you, when I see a 10-year dividend growth rate of 36%, I get very excited. I think that is fantastic. And it's a technology firm. Okay, technology firms are supposed to pay dividends or growing dividends, but we know that's not true anymore. The rules have changed. Look at Microsoft down the list. They've been growing their dividend for 19 consecutive years. Anyway, back to Broadcom. They have a very safe dividend. The payout ratio is 45%. I typically don't want to see anything more than 60 or 65%. The payout ratio is basically the ratio of dividends over net profit. So that is a safe dividend. PE ratio, we already talked about PE, compared to the sector median. And this is the technology sector. Broadcom has a PE ratio of 26.84. It's a little bit more than sector median, but it's pretty much in line. Sector median is 25.3. Market cap, this is a big company. They are ranked number 12 in the world, $589 billion. It is a pricey stock. It's $1,275 a share. These prices are as of yesterday, Thursday, February 8th. I am excited to say that I got into Pricecom at less than $600. And I was choking on that because I thought that was a lot of money. It is a lot of money, but I've more than doubled my holdings just by price appreciation. And I love that dividend. Levered free cash flow margin, this is the best part. 37.56%. They have so much cash. They have more than 4.5 times free cash flow after paying their bills and their loans and debts than the sector median, which is only 8.65%. That is fantastic. Every single one of these stocks has a huge levered free cash flow margin. Another company, Intuit, if you're familiar with TurboTax, this is not something that was even on my radar. 10-year CAGR, a little under 17%, growing 12 consecutive years. It's a very modest dividend yield, less than 0.6%. Payout ratio is very safe. Okay, they play it safe, 21%. PE ratio is high, 39. I don't know that I would buy this now compared to the sector median. Uh, and the price is high. It's over $653, but I want to put it on your radar. Um, and the levered free cash flow margin is very high. It is about 3.5 times the size of the sector median. It's 29%. I am absolutely in love with Oracle. I don't own any yet, but I want it. 10-year CAGR, 16%, growing 9 consecutive years. Yield for the tech sector, it's not bad. It's kind of modest, 1.36%. Payout ratio is safe. It's less than 30%. PE ratio is less than the sector median. And I'm stomping my foot because this is fantastic. Market cap 322 billion. They're ranked 29 in the world. Price $116. You could go scoop up a bunch of these. And look at that levered free cash flow margin, more than 20%. It's 2.5 times the size of the sector median. And of course, there's Microsoft. Oh, we love Microsoft. Microsoft is now the most valuable company in the world. That market cap over $3 trillion. 10-year CAGR 11%, growing that dividend 19 consecutive years. Dividend yield, kind of modest, less than 0.75%. But I tell you, when I see that 10-year CAGR, I get excited. Uh, PE ratio is kind of high. I mean, remember, they're over $400 a share. So a lot of people are buying in. The PE ratio is over 35. Uh, the sector median is all kind of high. It's 25. It's greater than the overall market at 22 that I showed you on a couple slides ago. But look at that levered free cash flow margin. They have cash to burn, 25.78%, more than 3 times the size of the sector. Now, this next one is not one that I would normally think of, as a dividend stock, but it is. Accenture, the global consulting and technology firm, 10-year CAGR 10.73%. Now, they've only been growing for 4 years, so they're on the list, but I'd watch them closely. A decent yield for this sector, 1.4%. Payout ratio, a little under 42%. It's okay. PE ratio is a little bit high. It's eyelash over 30. It's a big company. It's 47th in the world. Market cap is $230 billion. If you want to buy a share, it's going to cost you $368. Levered free cash flow, it's more than the sector median. It's almost 14%. And here is a special pick. I added Qualcomm, and I added Qualcomm for a few reasons. Now, their 10-year CAGR is not 10%, it's 9.25%. I'm great with that. What I love about Qualcomm is that they have a 20-year dividend growth streak. They will be an aristocrat in 5 years, and they have a very secure, solid position in the chip market. Their wireless technology is phenomenal. Look at that dividend yield. It's over 2%. They're the only one on the list that's over 2%. Payout ratio is safe, little under 36%. Look at that PE ratio, 15. It's way under the sector median. I tell you, they're on the list. I own several shares of Qualcomm, and I'm loving it, and I want more. The market cap, well, they're 72 in the world, 162 billion. The price, $148. I want more Qualcomm. Levered free cash flow margin, this is great. More than 3 times, about 3 times the sector median, almost 26%. Remember that name, Qualcomm. All right, let's go to the financial sector. All right, what you're going to see are banks and credit cards here. The only company on my list that has a higher 10-year CAGR is Bank of America. Broadcom was 36%, Bank of America 36.83%. They have been growing their dividend for 10 consecutive years. I like that yield. It's almost 2.9%. It's not bad at all. Payout ratio is very safe, a little under 30%. PE ratio is 10.56%. This sector median has a much lower average for the PE ratio. This sector has a PE ratio average of 10.36. Bank of America is an eyelash above. It's really just in line with it. It's a big company. It's 38 in the world, 262 billion market cap. It is very cheap, 33 bucks a share. And look at that levered free cash flow margin. It's a thing of beauty, almost 44%. It's more than two times the size of the sector median, maybe two and a half. MasterCard. Well, I got to tell you, I love that 10-year CAGR, almost 24%, 12 years growing that dividend. It's a very, very modest dividend yield. In fact, I could take MasterCard and Visa together. They're both almost identical, except MasterCard has been growing quicker, but they're smaller. So they've had more room for an upside. But MasterCard's been growing for 12 consecutive years, Visa for 15. Both those yields are small, less than 0.75%. The payout ratios are less than 22%. PE ratios are a little bit high. I mean, you're looking in the high 20s, low 30s. Look at the market cap. These companies are behemoths. MasterCard, 431 billion, 19 in the world. Visa, 561 billion, 13 in the world. These are huge, and they're more than just credit card companies. They're payment technology platforms. They have their own platforms where they accept electronic payments worldwide. They're huge. You can see the share price. MasterCard is quite a bit more expensive. It's been bid up over the last few years, over $450 a share. Visa, 276. But I love the levered free cash flow margin, both around 45%, killing it relative to the sector median. Next one, the big bank, JP Morgan Chase, is actually a bigger bank than Bank of America. Um, has a decent 10-year CAGR, not nearly as impressive as Bank of America, but it's more expensive. And the dividend yield is a little bit lower, but they've been growing for about 9 consecutive years. Um, Payout ratio is very safe, 25%. PE ratio is basically in line, a little bit more than the sector median. It's about 11. 15 in the world, $504 billion. You want to buy a share? It's going to cost you 175 bucks. I love that margin of levered free cash flow, a little under 37%, about 20 percentage points more than the sector median. And then the last for this sector, American Express, 10.43%, 2-year dividend growth streak, a very modest yield of 1.15%. Payout ratio, 21%. It's a very safe dividend stock. It's a little bit pricey compared to, for instance, JP Morgan, but cheaper than Visa and MasterCard. 16 PE ratio, so it's more than the sector, less than those other two. It's 80 in the world, $151 billion market cap. You want to buy a share, it's going to cost you $211. I like the levered free cash flow. It's about 23%. All right, let's go to the next sector. And we got consumer discretionary. So I've got 4 picks here. 3 of them are special picks. And I'll tell you why. I like the 10-year CAGR for Tractor Supply Company and Lowe's and Starbucks. Both of them are now within the top 100 market cap. And let me take Tractor Supply first. That is by far the smallest company. Their market cap is only 25 billion, but I watch it closely. They're ranked 735 in the world. But look at that 10-year CAGR, almost 24%, growing 12 straight years. Dividend yield, little under 1.9%. Payout ratio safe, little under 41. PE ratio is a little bit high. It is almost 23. It's more than the sector of 15.77. Most of them are high in this sector. People are buying because they figure that these are safe investments and they want in. Market cap, as I mentioned, about 25 billion. If you want to share of Tractor Supply Company, it's going to cost you about $232. The levered free cash flow margin, it's a little bit under the sector median. It's 3.14%. So I got to tell you, I am encouraged when I see that dividend growth streak. I also like to see the payout ratio in a safe range, and the 10-year CAGR is phenomenal. I calibrate my analysis with a levered free cash flow margin. So when I see that it's a little bit low, I think, well, okay, maybe I wait. But you may want to jump in. And the PE ratio is a little bit high for me if I'm looking at how they compare against the sector, but they're basically in line with the overall market, the S&P 500, which is around 22. It was 22 and a half. Go back a few pages and you'll see. Next special pick, Lowe's. I tell you, I like Lowe's because I like that 20% CAGR. They are not in the top 100. They're 107 market cap, about 127.5 billion. They are a dividend king. They've been growing their dividend for 60 consecutive years, longer than I've been around. And the payout ratio is safe, a little under 32%. The PE ratio, I love this. It is only 17. It is very much in line, a little bit more, but really much in line with the sector median. You want a share of Lowe's, and I own several. It's going to cost you around $220. Levered free cash flow margin, almost in line with the sector median. It's about 5.25%. I'm going to take Home Depot last. Let's go to Starbucks, another special pick. 17%. That's a great 10-year CAGR, growing 13 consecutive years, 2.4% yield. That is a nice dividend yield. Payout ratio is a little bit under 60, still safe. P ratio, a little on the high end for this sector. They're not within the top 100. They are around 133 in the world. Their market cap's about $108 billion. You want a share, it's going to cost you about $97 a share. But look at that levered free cash flow margin, 9.5%. That's why they're on it. And now the regular pick, who got in just through their own numbers, Home Depot, 10-year CAGR, 18%, 14-year growth streak, dividend yield, 2.3%. That payout ratio is safe, 54%. And they're going to keep growing it. P ratio is a little bit high, 24. Market cap is very high. It's 361 billion. They're 25th in the world. You want a share of that's going to cost you about $364 a share. But look at that levered free cash flow margin, like Starbucks, over 9.5%. That is phenomenal. All right, that's consumer discretionary. Let's go to the next one. Next one is industrials. I got to tell you, I really love industrials. It's my favorite. They had in consumer discretionary. I actually own two of these three stocks. I own the special picks, but let me do Union Pacific, the railroad company. 10-year CAGR, more than 13%, growing for 17 consecutive years. They got a yield over 2%. Payout ratio is safe, a little over 50%. The PE ratio is more than the sector median. So compared to the overall market, this sector is undervalued or underpriced, however you want to call it. Um, PE is about 22.3. People realize that this is a good stock and they're in. And if you want a share, it's going to cost you about $249 a share. This company is market capped at 152 billion. It's ranked 82 in the world. That lever free cash flow margin is beautiful. It's more than double the sector median. It's almost 15%. Sector median is about 6.25. So I am looking closely at Union Pacific. I love Union Pacific. I don't own it yet, but I'm watching it. The next two I do own. I own ADP. It's the third party human resources slash payroll provider that a lot of companies use. Look at that CAGR of 12.56%. They are a dividend aristocrat. They've been growing the dividend for 25 consecutive years. They got a dividend yield of 2.25%. Payout ratio is safe. Eyelash under 60. PE ratio is a little high, about 27.5 compared to the sector median of 18.7. People like this company because it has a growing dividend for 25 years. And if they're paying attention, they do their digging like me, they see that they have levered free cash flow margin of almost 3 times the sector median of 17%. You want a share of ADP? Going to cost you $251. And last but not least for this sector is United Parcel Service, UPS. 10-year CAGR, 10%, 14-year growing streak. That dividend yield is almost 4.5%. It's a high dividend yield. It's a healthy dividend. They pay over, I want to say $6.50 a share. The yield has gone up because the price has been taking a beating the last year or so. They've had some bad press. They've had some union decisions that were challenging for the company, but it's a really good company. Um, Payout ratio, I think, is a little bit high. It's almost 74%. I have several shares of UPS. I watch this closely. I haven't sold anything. In fact, I've been buying more because I think that I think the price um, could come down a little bit more, but it's been going down, and I've been buying a little. um, the sector median is more than the PE ratio for UPS. So it's looking pretty decent to me. I'd like to see it come down a little more, but I think it's a good buy. It is not in the top 100. It's 110 market caps, $125 billion company. You want to share, it's going to cost you $148 billion. Lever free cash flow margin, well, it's a little bit less than the sector median. It's about 4%. All right. That is the industrials. Let's go to healthcare. I got three stocks here. All right. And none of them are special picks. They all got in on their own. United Healthcare, the huge health insurance company, they have a 10-year CAGR of 21%. They've been growing for 14 straight years. Dividend yield is modest, about 1.5%. Payout ratio, 29%. PE ratio is really in line with the sector median. It's 18.77. You can see the sector median is 18.75. This company is ranked 18th in the world. It is a big company. Market cap about $480 billion. It is not cheap. If you want to buy a share, it's going to cost you $520. Levered free cash flow margin, it is much, much more than the sector median. It's 4.87%. Sector median is around 0%, slightly negative. One thing to keep in mind with this sector, it's a very big and diverse sector. You have health insurance companies, you have pharmaceutical companies, you have companies that are doing a lot of expensive research and development on cutting edge drugs and treatment medications, and that costs a lot of money. So that will go into cash flow. So that's and whereas United Healthcare is a health insurance company, a healthcare company. Abbott Labs, it's a medical supply company. They have an excellent 10-year CAGR, much less than United Healthcare, but still excellent, 12.5%, growing for 10 straight years. Dividend yield almost 2%. Payout ratio, it's about 47%. That PE ratio is a little bit on the high end, about 25. And you look at the price; it's only about $113 a share. People are buying in; it's driving up the price in the PE ratio. It's ranked 59th in the world, about $197 billion market cap. Levered free cash flow margin is fantastic, 11.5%, much bigger than the sector. Last company, Novo Nordisk. This is not an American company. It is a foreign company. It's a drug company. You may have heard of it. It is the manufacturer and the developer of Ozempic. It is the diabetes and obesity treatment drug that half the country is on, and they are a cash cow for Novo Nordisk. Have a wonderful 10-year CAGR, about 12.75%. Dividend growth streak, it's only 4 years, but it's 4 years. So that's pretty good. I'm watching it closely. I do have several shares of United Healthcare. I do not have any shares of Novo Nordisk yet. I'm watching it. Payout ratio is safe. It is 51%. PE ratio is high. It is double the sector median. I think a lot of people, they know about Ozempic. They want in. It is a safe investment. Look at that market cap. It is bigger than United Healthcare. It is 529 billion, ranked 14 in the world. Price $118. It just doesn't seem that expensive when you look at only in the price. But you got to look at other things. You got to look at PE ratio and look at that levered free cash flow margin. They're killing it. 23%, killing the sector median. Let's go to consumer staples. I got two selections here. Bear with me, we're almost there. We got Costco and we got PepsiCo. Both have really nice 10-year CAGRs. Costco got in based on their numbers alone. 12.65% 10-year CAGR, 19-year growth streak. a very modest yield, dividend yield 0.57%, but the payout ratio is safe, less than 27%. What's high? The PE ratio is high. It is more than double, more than 2.5 times the sector median. People recognize that Costco is a great investment. They're not going away, they're growing, they're expanding. The question is, are they overpriced? They may be. But I have several shares. I like it. If you've been watching the news, they paid a special dividend just a couple months ago. So even though you get a quarterly dividend, which is only 0.57% annual yield, we got a special $15 per share dividend, which was wonderful. And I was on the recipient of that. Market cap $319 billion. They are ranked 27th in the world. Share price, hold on to your socks, folks. $724 a share. Levered free cash flow margin, well, it is less than the sector median. It's 2.8%. But believe you me, they got a lot of cash. And next one and last one for this sector, PepsiCo. We all like Pepsi. Maybe we don't. Maybe we like Coke better. But as far as a dividend stock goes, they're a special pick here. They're a special pick for a couple reasons. They did not meet the 10% 10-year CAGR. However, they're 8.28%. They're kind of close, but look at that dividend growth streak, 51 years. Wow. And I tell you, I do like, if you go to the far right, that levered free cash flow margin is more than the sector median, almost 6.9%. PepsiCo is a big, successful conglomerate company. If you like Fritos, they own Fritos. They own a whole variety of food stuffs. So it's not just the soda, Pepsi. They own other sodas. They own other foods. Go to the website, take a look at it. At market cap, it's big. They're ranked 42nd in the world, $238 billion. All right, next one. Next one is the materials sector, and this is the last sector. This is a special pick. Materials company called Lyondell Basel. Why did I pick them? And why did they not get in based on their own numbers? Well, their 10-year CAGR is 9.46%. So it's not quite 10%, but it's pretty damn close. Growing that dividend 10 consecutive years. Look at that dividend yield, 5.29%. You know, if you want to buy a share of that, it's under $95. That is a high yield with a high dividend CAGR. Payout ratio is still safe, so they're getting it done. They're growing that dividend, and the payout ratio is 57%. I also love that the PE ratio is only 10.98 versus the sector of 16. That tells me that the price is a little bit depressed compared to their peers in this sector. Market cap is only 30.6 billion. They're ranked 597 in the world. So it's a smaller company. Levered free cash flow is a little under 4%. It is under the sector median of 4.6, but it's kind of close. So, folks, that is it. Those are the 25 stocks. And before we close down, I just want to share some resources with you. If you like the video and you like the one-way communication, continue to listen. I would ask that you like the video and subscribe to it and hit that notification bell. So every time a new video comes out, you'll know about it. I am on other platforms. I am on Facebook, and I am also on Instagram, and I am also on X. You can connect to me on any of those platforms. Just type in Dividend Blasters. There are some other resources of colleagues of mine that I want to share with you. So, for instance, first of all is Dividend Snowball. Dividend Snowball is a wonderful group on Facebook and on X, formerly known as Twitter. If you like a lot of collegiality and collaboration with colleagues and an opportunity to learn from other people and to share information, Dividend Snowball is a wonderful platform. Another one is Dividends Are Us. And I collaborate with the leadership of both of these platforms. Dividends Are Us is on Facebook. They are on YouTube, and they are also on X. And I'm connected to all of them. We share information, and we're all very much like a club. So I would urge you to take a look at Dividend Snowball and Dividends Are Us on Facebook and on X. And then we have two more I want to mention: Glorious Dividend Investors on Facebook. Another great platform where there's a lot of good information shared, as well as Savings and Investing for Beginners, also on Facebook. Not just dividends, but investing. And if you're new to investing and you want to learn about investing plus dividends, take a look at Savings and Investing for Beginners on Facebook. All right, folks, that is it. I thank you for your time, and I hope you found this to be enjoyable and insightful. Please give us a like, share the video with a friend, hit that notification bell, and subscribe to our channel here on YouTube at Dividend Blasters. Have a wonderful day, and until our next video, God bless.